Hello, this doesn't look like the annual report of a telco. This looks more like the annual report of an entertainment company. And I guess that's precisely the point. Singapore Telecom's annual report, full of smiling, happy people talking about raising business performance, enhancing customer experience, and improving productivity. But all in bright colors with smiling, happy people bouncing around its various pages, talking about embracing innovation and building strategic partnerships. The whole point of this annual report is in fact to show how SingTel has changed from being just a telco to a company which is integrated throughout various parts of the business. In other words, not just carrying the data, but actually taking care of the content itself. For example, through its acquisition of Amobi, the mobile advertising platform, and Eatability in Australia, a restaurant review site. In Singapore, of course, they bought Hungry Go Where. So we can expect more of that, it seems, and I'll tell you more about it as we go through the annual report in the next 5 minutes. And incidentally, not just those digital acquisitions, but the regional ones as well. They did have a few problems in some of their regional associates. For example, Airtel showed some poor results, which I'll show you in just a few minutes. But the chairman, Simon Israel, in his statement says that Airtel will improve in the medium to long term. So that's obviously going to drag on for a little while longer, and you might want to ask about at the AGM. In Pakistan, after an extensive review, he says they made a decision to exit Worried Telecom, taking a $225 million charge, that is. There is a silver lining, though, to the worried exit, and I'll show you that little footnote again in the next couple of minutes. Chua Sok Kung, in her statement, CEO's statement, points out she didn't want SingTel to become just a dumb pipe. That's why they're spending so much money on their digital acquisitions. In the digital space, they're going to continue to invest, but they're also looking to increase their stakes in associates and invest in large underpenetrated markets. Underpenetrated markets, is there any left in the world? How about Myanmar? Problem is, SingTel didn't win in its bid to launch one of 2 telecommunications licenses in Myanmar. The word Myanmar, if you do a search in the document, doesn't even come up, but I bet it'll come up at the AGM because, again, if they're looking at large underpenetrated markets, well, how are they going to get into Myanmar if they don't actually have a license there? Perhaps they'll become a service provider to the licensees, Telenor being one of the 2 that won it. So again, digital and regional associates very much in focus in this annual report. Back to the digital part. They're looking to invest $2.5 billion in networks in the coming year and another $2 billion over 3 years in the digital space. Now, she does warn here that these investments might register losses in the short term, reflecting their investment phase, but they've got the safeguards in place, she says, to make sure that in the medium to long term they do see results. Also interesting here is this comment that at the right time we will selectively unlock and monetize the value of our digital investments. Really all that means is that they're looking to sell those digital investments again at some stage in the future. So it's not just about buying them, but at some stage about exiting them as well. At the same time, there's quite some interesting commentary about how they're rolling out those digital assets across their regional associates. Right now, the digital assets, though, make up a very small part of the business. This is the group consumer page, which focuses obviously on, your mobile phone, my mobile phone, in essence, the retail aspect of their telecommunications business. That's still the big kahuna, $11.6 billion in revenue. Their enterprise business, looking after business customers with their ICT solutions, $6.44 billion, so just over half of their consumer business. And digital, $111 million. So you can see how small that is compared to the rest of their business. It's not to be sneezed at. $111 million is a lot of money, but you can see how that part of the business is really just in its infancy, the so-called digital life business. Let's now look at some of the key statistics and numbers, and let's make this as pain-free for you as possible. First, looking at the operating revenue, you see that there was a decline First, because Australia's Optus didn't perform in the same way as it did before, and second, because the Singapore dollar keeps strengthening, and the Australian dollar keeps weakening. So as that money is translated into Singapore dollar terms, there is a decline. The underlying net profit, when you look at how Airtel has been performing, for example, weaker regional currencies, again, the strengthening Singapore dollar has put a little curb there on the underlying net profit. It's still 3.6 billion. It's really the second decimal place then where we see the decline. The net profit number, when you take into consideration depreciation charges and those investments in digital businesses and some of their exceptional losses, you can see the figure falling from almost 4 billion last year to 3.5 billion this year. Here's that bit about Worried Pakistan, $225 million charge, but that's not the only exceptional item which weighed on that net profit number that I just showed you. There was also costs of the workforce restructuring at Optus. That was $100 million. And also depreciation charges, $114 million. They did have net dividend income from Southern Cross of about $150 million and gained on Far East Tone Telecommunications, $120 million. So all up, that's when you see here that the exceptional losses were $154, when you kind of balance them all out. So these exceptional losses were the reasons why net profit was down. This is how the dividend is looking, 2.7 being the ordinary dividend. No special dividend this year compared to 2 years ago. So the ordinary dividend keeps rising, and usually when the ordinary dividend keeps going up, that means the company has confidence to maintain that dividend for at least some time. And we see 2 cents, 2.5 cents being maintained for 2 years at a time. Special dividends are really only paid when there is really something to celebrate and get out the champagne. Now let's look at the various countries that SingTel operates in. It's called Singapore Telecom, but for quite a number of years now, Singapore has not been the dominant part of the business. Less than a quarter, in fact, of their earnings before interest and tax, depreciation and amortization comes from Singapore. Australia is, by contrast, at about 1/3 of their EBITDA number, whereas the regional associates make up almost half. So in terms of earnings, Singapore has really taken a back seat. Where is the money coming from? Not surprisingly, it's mobile. Mobile communications up 2.9%, data up 2.5%. And you can see that again in this pie chart, mobile making up almost 30% of their total revenue, data and internet a quarter, IT and engineering 23%. And you remember the IDD calls, in other words, calling locally or calling internationally? Well, look at them. They're just very small now in percentage terms of their overall revenue pie. 7% for international and 5% for national. MEO is in here with just a 2% contribution to overall revenue. In Australia, as I mentioned, a much bigger business in earnings terms. Australia didn't do quite so well. Tough operating revenue, rather tough operating environment, revenue declining 4.6%, but EBITDA actually grew 1%. In other words, they took less money in, but were more profitable for it. Mobile revenue was down 6% because they sold fewer handsets, and there were also various service credits that they had to honor. Their revenue from business and mobile, wholesale fixed rather, was stable, and we see that again in this pie chart here, where mobile makes up about 2/3 of Optus's total revenues. Okay, so having looked at Singapore and Australia, let's look at those regional associates, the ones that make up almost half of their total EBITDA earnings. And you can see here a particular comment that I made a few minutes ago, how they're looking to roll out their digital services, not just in Singapore and Australia, but also to their regional associates. And you can see why. In the emerging markets of Indonesia, India, Thailand, and the Philippines, they say, voice revenue is already slowing. In other words, the growth in voice revenue, in phone call revenue, is already plateauing. And that's not really surprising, considering that mobile saturation is increasing. In other words, more and more people in these markets have a mobile phone. And two, data services are becoming more and more important. So as a result, that's why they're looking to move their digital know-how into those other markets as well. This is a fairly busy table, but let me talk you through it quickly because it's a very important one to understand the significance of those regional associates. Telkomsel now contributed more than $1 billion in pre-tax profits. AIS in Thailand went from 350 to almost 440. And there's the Airtel number. This is the problem number which I promised you earlier I was going to tell you about. In India, Bangladesh and Sri Lanka, it's fallen from more than 600 to less than 500 million, down 20%. In Africa, the losses keep widening. And that's where Simon Israel said it'll take the medium to the long term to fix those issues. Globe, in the meantime, seemingly growing here. Worried, this is the last line item, I think we'll see the losses narrowing there somewhat. Interestingly, Southern Cross, I picked this one out of the notes towards the back of the annual report. Kind of interesting if you're an accounting buff. Southern Cross, that joint venture in which SingTel owns just short of 40%, is no longer going to be equity accounted from the 1st of April this year. So instead, the dividend income is going to be recognized in the income statement instead. So look out for that next year. We might see a slight blip then as that adjustment is made. Now, in relation to Worried Telecom, I did promise you a silver lining to that exit, and here it is. It's in note 44 of the financial statement. So again, way back in this 200-page document. And you can see here that under the terms of the sale of Worried Pakistan, SingTel is actually going to get 7.5% of the proceeds of any future sale, public offering, or merger of Worried Pakistan. In other words, it's divested the business, it's pushed away the loans that previously were, or its liabilities that previously were its responsibility, but it's still going to get 7.5% of the proceeds if the buyer of Worried Pakistan from SingTel sells the business again or lists it. So, won't that be interesting? We'll see an abnormal gain at some point in the future if that actually comes to pass. And then, looking at the cash received, so we've looked at the pre-tax profit numbers. Let's look at the cash. Telkomsel in Indonesia makes up almost half of the amount of money, the almost $1 billion which SingTel receives from the associates. This is cash before the withholding taxes and hedging and so on. AIS almost 30%, Globe 12%, and there's Airtel, Southern Cross, Singapore Post and others lumped in together for another 11%. In terms of post-tax profits, Telkomsel once again more than half, Globe 10%, Airtel makes up 11%. So in cash dividend terms, Airtel is relatively small, but in profitability terms, Airtel does contribute. Now, Airtel's operating revenue. This is where we see some of those things come through. Remember, Airtel is underperforming in terms of pre-tax profits, but revenue was up 12%, EBITDA up 5%. The amortization charges on the spectrum and the mobile expansion, along with increased finance costs, were the reason why Airtel is kind of limping along a little bit in its contribution. Now, let's have a look at the currency translation, and this is something which rarely comes up for large-scale discussion. People tend to accept that the stronger Singapore dollar, which gives Singaporeans greater purchasing power, is going to impact their export revenue. And you can say that the amount of money that Singapore Telecom gets from outside of Singapore is also a form of export revenue. The associates' pre-tax contributions grew 5%, but would have grown 12% if not for that currency translation. So you can really see how much of a difference the stronger Singapore dollar makes to the earnings of SingTel. Let's look at the cash flow statement as we round out our review of the annual report of Singapore Telecom. Cash inflow was $5.8 billion, but they reinvested $2.5 billion in the business and had cash outflow for financing of $3.7 billion. As a result, their cash balance was reduced by more than $400 million and fell from $1.3 billion to $911 million. So cash balance is down, even though cash from operations continues to grow. And that's again because they repaid about $800 million worth of debt, plus they reinvested in the business. Speaking of debt, this is where we see that number. Gross debt here, let's look at the bar chart. I think that's probably a little bit easier. Gross debt was down because of that $805 million repayment. Net debt, when you strip out the cash that they still have on the balance sheet, was also down over last year's number. The net gearing ratio, which the accountants look at, has gone from 25% to just below 24%. and they can pay their interest bill 24.5 times over. So it doesn't look like they're in any great strains with their debt. So that's the annual report. Review it for yourself, read it for yourself before you attend the annual general meeting. I'm Mark Laudy. Thanks for watching.